Usually when you pull up a stock chart and see that 34% of the entire public float has been sold short, your first instinct is to walk away. Heavy short interest usually means Wall Street smells blood in the water. They think the company is a failing brick and mortar, a tech fad losing cash, or a business trapped in a death spiral. But what if the obvious conclusion is dead wrong? What if those short sellers are currently trapped in a company that just grew its revenue by 2,000% in a single year? Today we are looking at Rezolve AI, and I am going to show you why one of the most heavily shorted stocks on the market might actually be setting up for one of the most violent upside re-ratings of the entire year. If you have been wondering whether the gamma squeeze everyone has been whispering about is finally on the verge of igniting, stick around, because what I am about to break down might change how you look at this trade entirely. If this kind of deep dive analysis helps you spot opportunities before the crowd catches on, take 1 second and hit that like button and subscribe so you never miss an update. But to understand why this powder keg has not blown up yet, we need to look at the three forces converging on this stock right now. We are currently looking at what I call a perfect storm scenario. In the financial markets, you rarely get technicals, fundamentals, and market mechanics all pointing in the exact same direction at the exact same time. First, you have a structural floor that is held up against intense selling pressure. Second, you have a fundamental ceiling that is essentially blowing off due to a massive, verified earnings beat. And third, you have a trapped short seller demographic staring down the barrel of an active corporate buyback. When you combine these three elements, you stop looking at this as just another tech stock and you start looking at it as an asymmetric pressure cooker. But could all three pillars really sustain themselves simultaneously without one of them cracking under the weight? What are the odds that technicals, fundamentals, and squeeze mechanics all align perfectly at the same moment in time? That sounds impressive in theory until you look at what is actually happening underneath the hood with the price action. In my last video covering RZLV, I laid out a very specific technical roadmap. I told you that the accumulation zone, the absolute best place for smart money to park their cash, was between $2.15 and $2.25, with a non-negotiable hard stop at $2.05. Look at what happened this week. The sellers tried to flush it, and the stock dipped to a local low of exactly $2.20 on July 28th. It tapped the dead center of our accumulation zone and bounced. The downside floor is structurally defended. Buyers stepped in exactly where they needed to, and our $2.05 stop loss was never even tested. Now ask yourself this: how often does a stock under this much short pressure land on a technical level to the penny and hold? What are the chances that kind of precision happens by accident? Here is where the story starts to get more complicated, because if the floor is so strong, why has the stock not exploded higher yet? The answer lies in market mechanics. The massive, violent squeeze we are anticipating has not ignited yet because of a massive wall of resistance sitting squarely at the $2.50 strike price. This is not just natural selling. This is a heavy options wall. Market makers and institutional sellers are aggressively defending that $2.50 ceiling. On July 31st, the stock pushed up to $2.46, but that heavy options interest slapped it back down, keeping it pinned. RZLV closed the week strong at $2.43, but it is basically coiled like a spring right underneath that breakout level. The market is not rejecting the stock. It is simply absorbing the latest news, pulling the tension tighter and tighter. But what if that tension never releases? What if market makers can hold that wall indefinitely and bleed the momentum dry before buyers ever get their chance? And that brings us to the one question investors actually care about. What exactly is the news that this market is struggling to absorb? Just one day after my last video, Rezolve AI dropped a fundamental shockwave on the market. They released preliminary financial results for the first half of 2026, and they announced a staggering $127 million in revenue. Let that number sink in for a moment. This is not a projection. This is not forward guidance. This is cash on the books for just a 6-month period. For a company trading in the $2 range, a 9-figure revenue print completely changes the math on how this business is valued. But here is the uncomfortable question nobody wants to ask. What if the market already knew? What if this revenue figure is already priced in and the stock stays pinned regardless? To fully grasp how absurd this number is, we have to zoom out and look at where this company was just 12 months ago. In the first half of 2025, Rezolve brought in just $6,320,000. They are now printing $127 million. That is a 20 times increase, a 2,000% velocity jump in 12 months. In fact, this single 6-month figure exceeds the company's entire 2025 audited full-year revenue of $46.8 million by more than 2.7 times over. This is not incremental, organic growth. This is a fundamental re-rating of their earning power. When you see a chart that looks like this, the old valuation models you were using are officially obsolete. But can any company sustain this kind of hyperbolic growth without hitting a wall? What are the realistic odds that a 20 times revenue surge continues without a dramatic pullback in the next quarter? But before you get too bullish, there is another layer to this. Past performance does not mean much if the forward guidance falls flat. Fortunately, the forward outlook is even more aggressive. Management completely reaffirmed their massive target of $360 million in total revenue for the full 2026 fiscal year. Even better, CEO Dan Wagner publicly confirmed the company has successfully transitioned from concept to production. They are not just selling an idea anymore, they are servicing over 1,000 active enterprise customers. Because of this, they expect to exit 2026 with at least $500 million in annual recurring revenue. That recurring keyword is critical. It means predictable, highly valued cash flow, month after month, quarter after quarter. But let us be honest with ourselves for a second. How often do aggressive management targets like $500 million in AR actually materialize exactly as promised? What if execution stumbles and that number comes in at half? So, how exactly does a company scale from a few million to $500 million in recurring revenue this fast? You do not get 20 times growth by knocking on doors. You get it through deep integration into the world's largest existing networks. Rezolve has embedded its brainpower AI models into the Microsoft Foundry ecosystem, instantly granting them massive enterprise distribution. They have partnered with Tata Consultancy Services for global implementation across their enormous client base. But the crown jewel is their integration with the payment network Zilch. This deal connects RZLV directly to nearly 6 million consumers and taps into over $3.3 billion in annual merchant flow. They are not building infrastructure from scratch. They are taxing the infrastructure of modern commerce that already exists and already processes billions. But what if one of these partnerships dissolves? What if Microsoft or Zilch shifts priorities and Rezolve loses access to that distribution overnight? When you see a fundamental setup this strong, you naturally want to know what the smart money is doing behind the scenes. Well, the insiders are not just holding, they are aggressively hoarding shares. An entity tied directly to CEO Dan Wagner, known as DBLP Seacow, has quietly accumulated roughly 9 million shares since the start of the year. Furthermore, a major investor named Alejandro Gonzalez just disclosed a 7.5% passive stake, which translates to over 30 million shares, with absolutely perfect timing right around the Zilch announcement. Combined, these two entities alone have locked up over 39 million shares. Let me be clear about something. Insiders do not aggressively lock up tens of millions of shares unless they expect massive, life-changing upside. They have access to information, timelines, and pipeline visibility that we simply do not. When they bet this heavily with their own capital, it tells you everything you need to know about their confidence in where this company is heading. And that massive insider lockup creates a catastrophic math problem for the people betting against this stock. This brings us to the trap. Right now, a staggering 34.15% of the public float is sold short. That is roughly 35.94 million shares that short sellers have borrowed, sold, and eventually must buy back to close their positions. But remember what we just talked about. Insiders just locked up 39 million shares. The float is shrinking in real time. To make matters significantly worse for the bears, Rezolve has an active $300 million share repurchase mandate. That means the company itself is sitting there with a massive war chest, ready to buy their own stock off the open market, acting as a permanent structural floor beneath the price. So picture this scenario. You are a short seller. The float is disappearing. Insiders are buying. The company is buying. Revenue just exploded 20 times over. And you still need to find shares to cover your position. Where exactly do you find them? What happens when 35.94 million shares need to be returned and there simply are not enough available at current prices? So what happens when trapped short sellers meet an immovable corporate buyback? Let us look at the mechanics of the breakout. We are looking at a classic pressure cooker flowchart. Step 1 is the fuel. That is the 20 times revenue growth and heavy insider accumulation removing shares from circulation. Step 2 is the barrier. That massive options wall at $2.50 that pinned us down on July 31st. Step 3 is the ignition. The moment this stock breaches $2.50 on high volume, those options contracts go in the money, Market makers are forced to hedge by buying shares, and the 35.94 million shares sold short are suddenly underwater. That triggers step 4, the target. A violent price expansion toward the 50-day moving average at $2.62, and once shorts start panic covering, it likely blows right past it into uncharted territory. But is it really possible that all 4 steps execute in sequence without institutional players stepping in to suppress the move? Could the options wall simply reset at a higher strike and contain the breakout before it gains any real momentum? If you think that upside target sounds overly optimistic, take a look at what the institutional professionals are modeling. Wall Street is aggressively bullish on this stock, completely validating our internal thesis. Just a few days ago on July 28th, Northland Securities reiterated a rock-solid buy rating with a $7 price target. But if we zoom out and look at the consensus across 6 different professional analysts covering the stock, the average Wall Street price target sits at $10.75. These are not retail traders throwing darts at a board. These are trained analysts looking at the $500 million ARR guidance, examining the partnership pipeline, and realizing the stock is fundamentally mispriced at current levels. To put that mispricing into perspective, we need to quantify exactly how much opportunity is left on the table. Previously, the market was heavily discounting RZLV because of execution risk. Wall Street wanted proof that AI hype could turn into actual cash. With $127 million in verified first-half revenue, that execution risk has largely evaporated, but the stock price has not adjusted to the new reality yet. Closing the week at $2.43, a move to the consensus target of $10.75 represents an explosive 342% upside potential. The valuation gap has cracked wide open, and the window to capitalize on it is likely closing as more investors become aware of these numbers. But what are the real chances that a stock moves 342% based on analyst targets alone? How often do consensus price targets actually get hit within the expected time frame? So, how exactly should you play this? Let us break down the tactical matrix for both types of investors. If you are a short-term trader, your playbook is entirely about risk-to-reward asymmetry. Your prime entry remains that $2.15 to $2.25 accumulation zone. You maintain a strict, non-negotiable hard stop at $2.05 to protect your capital, and you watch like a hawk for a high-volume breach of the $2.50 wall to trigger the squeeze. If you are a long-term investor, your thesis is simple. This is a strong buy-and-hold opportunity. You let the company monetize its partnerships with Zilch and Tata Consultancy Services. You let management scale toward that $500 million ARR target, and you let the $300 million buyback support the stock while it grows into its $10.75 valuation. Either way, the risk is defined and the reward potential is asymmetric in your favor. Now let us bring this all together for the final verdict. Before I give you my conclusion, I need to be absolutely transparent with you. Nothing in this video constitutes financial advice. I am not a licensed financial advisor. Every investment carries risk, including the risk of total loss. Past performance does not guarantee future results. Stocks with high short interest are inherently volatile and can move violently in either direction. Always do your own due diligence, consult with a qualified financial professional before making any investment decisions, and never invest money you cannot afford to lose. With that said, here is where we stand. At the end of the day, investing is about finding convergence. You have a technical breakout setup where the $2.20 floor held perfectly and the spring is coiling tightly under $2.50. You have a fundamental explosion with 20 times revenue growth, 127 million in verified earnings, and over 1,000 enterprise customers. And you have intense short squeeze pressure with nearly 36 million trapped shares fighting against insider accumulation and a $300 million corporate buyback. Any one of these factors alone makes for a compelling trade. But all 3 together? That is the definition of the perfect setup. Watch that $2.50 level closely this week, because once the dam breaks, it is going to be a wild ride. Wolfo, now I want to hear from you. Do you think the $2.50 options wall breaks this week, or do market makers successfully defend it through the next expiration cycle? Drop your answer in the comments below. I read every single one. If this breakdown gave you a new perspective on RZLV, smash that like button so more traders can find this analysis. And if you are not subscribed yet, hit subscribe and the bell so you are the first to know when the breakout triggers. Until next time, trade smart, manage your risk, and I will see you in the next one.